Welcome, everyone, and thank you for attending today's webinar, Managing Volatility with Liquid Alternative ETFs, sponsored by IndexIQ and New York Life Mainstay Investments. I'm Drew Boros, Editor-in-Chief of ETF.com, and I'll be your moderator for today's webinar. But before we begin, we want to cover a few housekeeping items. At the bottom of your audience console are multiple application widgets that you can use if you have any questions during the webcast. I'm sorry. Let me start over. I'm sorry about that. But before we begin, we have a few housekeeping items to cover. At the bottom of your audience console, there are multiple application widgets that you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. We do capture all questions. In addition, there will be survey questions during the presentation, and at the end there'll be poll questions as well. Your slide area by clicking on the maximize icon on the top of the right slide area or dragging the bottom right corner of the slide area. If you have any technical difficulties, please click on the help widget. It has a question mark icon and covers common technical issues. Also, an on-demand version of the webcast will be available in approximately 24 hours. And you can access that using the same audience link that you were sent earlier. I'm sorry, I'm losing my voice. So, on to our webinar, Managing Volatility with Liquid Alternative ETFs. Presenting today's webinar are Charlie Reinhard of New York Life Mainstay Investments, where he's Managing Director of Portfolio Strategy. He also leads portfolio construction there. We also have Bruno of IndexIQ, where he is Chief Investment Officer, whose primary responsibilities include developing and maintaining the firm's investment strategies. So with that, I'll turn it over to Sal.
Thank you, Drew, and thank you all for taking time this afternoon to join us. So our agenda today is to talk about economic and market outlook, and Charlie Reinhard will join me for that, as well as some portfolio solution ideas to help dampen volatility using liquid alternatives, primarily ETFs. And I will join back in the conversation to talk about that. So I wanted to give a brief overview of who IndexIQ is and what some of our potential solutions are to help manage volatility. So we founded in 2006. We joined up with the New York Life Mainstay organization last year. Thrilled to be a part of the Mainstay organization that's helping us to develop additional, most innovative strategies to help manage volatility. Many of our products are low volatility. They provide attractive up-down captures and low correlations to traditional asset classes. And all of our ETFs are liquid, transparent, are relatively low cost, and strive to be as tax efficient as possible in keeping with the structural benefits of the ETF wrapper. So a quick overview of some of our investment capabilities, our lineup, before we jump into the economic outlook with Charlie. So our strategies are organized into a number of different categories. We have our absolute return, our most recent offerings are fixed income, real assets, and then the global international, which we're going to talk about in our currency hedge as a way of managing volatility in the international markets. So at a very high level, absolute return strategies encompass QAI, which is our flagship ETF. It's been around since 2009. Has almost $1.1 billion in assets. And it's a hedge fund replication ETF. And we're going to talk a lot more about how you could potentially use that in a rising interest rate environment, as well as ways of dampening volatility with QAI. Now, QAI seeks to provide a return stream that looks very much like a multi-strat hedge fund of funds without actually investing directly in hedge funds. So it uses the return streams from hedge funds to identify the common factors or beta exposures that hedge funds have, and then invest in those similar types of exposures through other ETFs. So it is an ETF of ETFs. Covers 6 different hedge fund strategies. Those individual hedge fund strategies that roll up into QAI are also available individually as standalone ETFs. We have QED, which is an event-driven hedge fund replication ETF, QMN, which is our market-neutral hedge fund replication strategy, QLS, which is a long-short hedge fund replication strategy, and MCRO, macro, which seeks to provide returns that are very similar to a macro-type strategy, again using hedge fund replication. The other offering in the absolute return is M&A, which is another strategy we'll talk about in a little bit more detail as a way of managing volatility. And as you can guess from the ticker, it's for mergers and acquisitions or merger arbitrage. And it's actually a mechanical implementation as opposed to factor-based. So it actually invests in individual deals of target companies as they're announced. On the fixed income side, we have AGGE and AGGP, which are our two most recent offerings. These are enhanced core bond ETFs that use other ETFs to represent different sectors of the aggregate bond universe. And we use a momentum methodology to overweight and underweight different sectors relative to the aggregate bond universe. Also in the fixed income, we have AGGP, which uses the enhanced core bond methodology. And instead of just using investment grade, which we do in AGGE, it actually adds high yield and emerging market bonds to the mix, also using a momentum methodology. On the real asset front, we have ROOF, which is a small cap U.S. REIT ETF, GRES, our global resources ETF, which invests in 8 different commodity sectors using the equities that are most sensitive to those different commodities. And it rotates around an equal-weighted average using valuation and momentum. It also has an equity market hedge to dampen volatility and reduce equity market correlation. Within real assets, in the small cap space, we have IOIL, which is global small cap oil companies, CROP, which is global small cap agribusiness companies, and KROO, KROO, and CNDA, which represent small cap Australian and Canadian stocks respectively. On the global international front, we have 3 partial currency hedged offerings, HFXI, HFXE, and HFXJ. And the I is for international, E is for Europe, J is for Japan. These are typically free float adjusted market cap weighted equity indices with a 50% currency hedge that are reset on a monthly basis. Lastly, in the global international space, we have QGTA, which is a replication methodology designed to replicate the performance of leading global asset allocation mutual funds. So very similar to the QAI methodology, except instead of trying to replicate hedge funds, we're trying to replicate leading mutual funds in the global asset allocation space. So a quick poll question. As we talk about our lineup of liquid alternatives, broadly speaking, across your client portfolios, what percent of your client portfolios are currently invested in liquid alts? Is it 0%, 1 to 5%, 6 to 10%, 11 to 20%, or more than 20%? So please enter your answer here, and then press the submit button, and we'll review the results shortly. So it seems like almost half are using 1 to 5%. Another almost 20% are in the 6 to 10 bucket. 18% actually have 0% liquid alternatives. And then we have 15% in the 11 to 20, and 3% have more than 20%. So most are in the 1 to 5% or 6 to 10%. Roughly 62/3 of the people have between 1 and 10%. So that's kind of interesting. Now to take us through our economic and market outlook, I'll introduce Charlie Reinhard.
Thank you, Sal. Thank you, Drew. And thank you, everybody, for joining us on the call today and sharing your time with us. So I figured we would talk a little bit about the world economy, and then we would dive into different areas of the financial markets. And why don't we just get right into it? What you're looking at right now is a heat map of the world. Now, if you take a look at the IMF's latest economic forecast, which was made in April of this year, the IMF is expecting the world economy to grow a little bit better than 3% this year in the aggregate. But as you can see from the different colors on this chart, we don't expect the economy to grow evenly in all parts of the world. In green, you see the fastest growing parts of the world economy. And so you're looking at India and China a portion of Africa and Southeast Asia. And even though China has grown a lot slower than what people have anticipated so far this year, it's still an area that is expected to grow much faster than the world economy. I'd say the IMF is looking for 6.5% growth. That's in line with what Chinese authorities are saying. And as we'll see later on in the presentation, although it's not growing as fast as some people would like, there are some signs that growth has stabilized in a very cyclical part of the economy. If you look at the United States, we got off to a very slow start this year with the economy growing less than 1% in the first quarter. In aggregate, we're looking at a growth rate that we expect this year and next closer to 2% in the U.S., or even a little bit above that. And you can see that by the gray coloring, which is the second fastest growth lane that we have here in the world economy. In aggregate, the developed or advanced economies are expected to grow at about a 2% clip. The U.S. Just a little bit faster, Europe a little bit slower, and Japan slower than Europe. But in all, a pace of growth that is not too different really from last year. So for the advanced economies, a rate of growth that is not really accelerating or decelerating very much from last year. The red that you see on this screen are some of the more hobbled spots. Russia, Brazil, which has been in the news considerably. Ironically, Brazil's stock market has done quite well despite the poor performance of the economy. So in aggregate, the world economy is expected to grow a little bit better than 3%. Advanced economies like the U.S., Europe, and Japan rolled together at about a 2% clip, with the U.S. Being a little bit better than the average on that front. And then the emerging market economies growing at about 4%. So it all averages out. Inflation is not a clear and present danger in the U.S. and in the advanced economies. And so as a result of that, that buys central banks the room that they need to have very accommodative policies. As you know, the Fed has throttled back on its plans to raise interest rates this year. When the year began, their dot plot was calling for 4 Fed rate hikes. It was then reduced to 2. And then, of course, now it looks like 1 or 2. I could tell you that the consensus opinion among the different boutiques and investment teams at Mainstay and our independent boutiques is that the Fed will raise rates 1 or 2 times this year. And that's not too different, really, from what is being discounted into the marketplace and what other consensus opinions look like. This is a chart that I've been using for quite some time, and it is the Fed's probability of a recession indicator. And so what's interesting about this chart is that even earlier this year, when people were concerned about the prospects of a recession, when we opened the year, we saw a widening in credit spreads. We saw a swoon in oil prices. The world was set up for China to grow at 7% or better, and when that didn't happen, there was a ripple effect. And a number of commentators spoke about a high likelihood that we might enter a recession. But as you can see here, according to the Fed's leading indicators and their methodology, the odds of a recession were never actually that high, and they aren't high right now. Leading economic indicators, which came out recently, had a nice jump higher shortly before Memorial Day. And if you take a look at the slope of the yield curve, it's still positively sloped. We're seeing activity in housing, which has a nice ripple effect. And so all of these things are pointing in the right direction. Growth is not going to be spectacular, but it looks like the world economy and the U.S. economy are poised to grow. I would say since 1790, the U.S. economy has had 47 recessions. There's no doubt in our minds that someday there will be a 48th, but we don't think that it's within view at this particular point in time. What you're looking at right now is a chart that shows how the stock market has historically performed around past Fed tightening cycles. The top blue line shows you the performance during slow Fed tightening cycles, like the one that we believe that we're in right now. The bottom line shows you the performance in faster Fed tightening cycles, which we don't think that we're in right now, but that the market was worried about at the beginning of the year. What the lines show you is the year leading up to the first Fed move. And as you can see, the performance on average during past cycles has been about the same, relatively undistinguishable from each other. But there is a decoupling that takes place once it's known if the Fed is embarking on a fast tightening cycle or a slow one. In a fast tightening cycle, the stock market doesn't perform historically very well at all. Usually there's a problem. Inflation could be getting out of hand and the Fed needs to play catch up, or there's some other imbalances in the economy that need to be addressed. But when the Fed has the luxury of being able to raise rates in a slow manner, as you see with the blue line, usually that bodes pretty well for the equity market. It means that things are not too out of kilter. There's a relative balance between growth, inflation, and other considerations, and that inflation is tame enough that the Fed has the luxury of taking its time and watching incoming data. It's not in a hurry to play catch up. This next chart here shows you the historical performance of the stock market during election cycles. So this is the performance in presidential election years or general election years like the one that we're in right now. And the way that we split this up is not by R's and D's, but rather by incumbents and challengers. So what we're looking at on the top line shows you the historical performance of the stock market in years where the incumbent party standard bearer wins. So it doesn't have to be the same person as 4 years prior. It's just the same political party. So in this case, for the incumbent party are the D's, and Hillary Clinton looks like she's the standard bearer for the Democratic Party. And if you notice, historically, the stock market does tend to do better in years during election years, that is, when the incumbent party wins. And the reason for that is that a good economy, a solid economy that's growing, that's not in recession, is also good for the stock market, and it's good for incumbents. So I think that's basically what we're capturing here. And as you can see, the gray line on the bottom, historically, if the economy is not cooperating, well, that's a good environment to be a challenger trying to take the keys to the White House from the other political party. When we look at the stock market right now, in the U.S., we're at an interesting inflection point. Relative valuation is slightly on the rich side, neutral to rich side. The forward PE ratio at about 16.5 against consensus earnings is just a little bit higher than the historical average, not crazy high, and it's also not terribly high when compared to the level of interest rates. But it is higher. Than the historical average, and we don't think that PE ratios in the U.S., for example, on the S&P 500, are likely to get any higher from where they are today. We think that advances in the equity market are going to have to come from good old-fashioned profits growth, and more importantly, underlying cash flow growth, which once we adjust for accounting accruals is highly correlated most of the time to profit growth. So the consensus of the analyst community is that profits will grow from $119 this year for the S&P 500 per share to $135 next year, and that we're getting closer to the day where a year-long profits recession transitions into profits growth. That's expected to take place beginning in the second half of this year. Whether it happens in the third quarter is almost 50-50 at this point. Most of it is slated for next year. A couple of headwinds that have been problematic in the recent quarters have been a strong dollar, which is no longer the case. So we think that that will run its course. And also the swoon in energy prices, which bottomed a few months ago, has since come back, and we think that that's going to cease to be a headwind going forward. We're also starting to see firming up in the manufacturing sector. It's not pointing towards rapid growth, but there is growing stability, ditto in China. And so for the world's two largest economies, that's important because the profit cycle tends to correlate pretty highly with the manufacturing cycle. And so, but here what we're looking at is a valuation chart for international developed equities using the MSCI EAFE index. And as you can see, for developed countries outside the U.S., that valuation actually looks pretty favorable as compared to history. And so we think that there is a lot of opportunity. You know, this is a call that's on managing volatility, really. And when we think about managing volatility, one of the hallmarks is diversification. And I think that it's no surprise to folks that are on the call here today that there tends to be a home country bias where people don't allocate internationally as much as might be recommended under normal times by different asset allocation committees. And so valuation we think is pretty attractive for developed stocks outside the United States. And I would say, too, that if you take a look at the world's top brands, about half are in companies that are domiciled outside the United States. So you get the benefit from more of what the world has to offer when you include other geographies into a portfolio. And historically, stocks that pay a dividend are less volatile than stocks that don't pay a dividend. And that's true whether we're looking at yielders or growers, companies that simply have a high yield or those that may not have a high yield, but they have an admirable record of raising their dividends. And I would just mention that if looking on this chart here, that the dividend yield on offer is higher for developed international equities than it is, for example, in the case of U.S. large cap stocks. What you're looking at here shows for MSCI EAFE on the top line a dividend yield of about 3.5%, as compared to the bottom bar, which is the S&P 500, a little bit better than 2%. So it's another way to get income productivity out of a portfolio to benefit from the long-term impact that dividends seem to have on both the risk side and as well as on the performance side, where on average over time dividend-paying stocks have done better. So when we put this all together, we think that we're in the kind of an environment for equities that a multi-year environment where we might be looking at single-digit returns that come from earnings growth and dividends in the United States, that plus a little bit of a valuation cushion for stocks that are outside the U.S. They're less far along in their bull market as compared to the U.S. now that we're a little over 7 years into ours and well above where we were at the high of the last bull market. What we're looking at now are high yield spreads and the rate and high yield default. We think that there's a lot of opportunity in credit. You don't have to be particularly bullish on the economy or on the outlook for profits, I think, to favor credit and equities over developed country sovereign debt or cash. Yields are incredibly low. We know that in the U.S. Yields are about 1.7% on the 10-year Treasury, lower than that if you go down the curve. And if you think that's low, just compare that to the negative rates on offer in much of Europe and Japan. So what we're looking at here are high yield spreads and high yield defaults. Moody's does think that defaults will continue to inch up. Most of that will be in the commodity, mining, and metals realms. But I think outside of those realms, balance sheets look pretty healthy, and that the prospect for profit growth and interest coverage looks pretty good. So we think that there are opportunities in credit, both in high quality, high yield, and also very selectively, and I want to emphasize very selectively, if you go down in credit quality as well. Again, We think that the prospect here is one of single-digit prospective returns as a reasonable base case. Nobody knows exactly what the future has in store, but if you look at this chart, there's a decent relationship between the starting yield of high-yield bonds on the x-axis and then what the subsequent 5-year total return tends to be. And so when you take a look at where yields are right now and then crisscross, it makes the case that at least it's reasonable to think that solid single-digit returns make for a reasonable base case that may or may not turn out, but make for a reasonable base case in the case of high yield, where short durations and coupon income often force a reversion to fair value in a somewhat quick period of time. And that's why when we veered from what we thought fair value was earlier this year, the snapback was pretty stark. When we think about the rally that we've had in oil prices, almost, I guess, doubling to about $50 a barrel from where we were just earlier this year, it's really not that unusual when you compare it against history. What we're looking at right now is a chart that shows the performance of West Texas Intermediate oil during 7 prior huge energy swoons from the mid-'80s up until now. And so you never really know if you have a bounce or a bottom until long after the fact. Our boutique that focuses on energy investing does think that we've recorded a bottom, but I would say that oil doesn't stand still for long. And so when you do get a bottom in energy prices, on average, you're up about 70% off the low 6 months later. And so when you take that into historical context, it's not that unusual what we've witnessed in terms of a bounce more recently, or a bottom, I should say. Now, when managing volatility, one thing we can do is we can be patient. In a 60-40 portfolio, about 80% of the volatility will come from the equity portion. And so that's something to keep in mind. Time has a pretty valuable impact, but not everybody can afford to wait forever. But historically, the probability of a loss in the stock market in any given month has been about 40%. But for 1 year, the market has been positive versus negative 80% of the time versus 20% of the time, which you see in the second blue bar. For 5-year holding periods, the market has been positive almost 90% of the time. Better record still if you look at rolling 10-year returns and rolling 20-year returns. So over long periods of time, the stock market has tended to produce positive results, and so that's one benefit. Investing is one of those things whereby you get rewarded handsomely by being very, very patient, but it's hard for a lot of people to do. How can you how can you stick with your financial plan? If you can take steps to manage volatility in a portfolio, you'll be less tempted to liquidate your portfolio, and you'll be more likely to earn the historical returns that you've seen in the equity market, the fixed income market, and in other asset classes. I'm sure everybody is aware that we had a pretty good correction earlier this year, but corrections happen. And what you're looking at right now is since 1928, the frequency of corrections in the stock market. And so on average, we experience, if you look all the way to the right, a little more than 5% corrections a year in the stock market. They tend to be relatively short-lived. They can happen for any reason or no reason at all. They're garden variety. About once a year on average, we get a 10% correction. Again, I would classify that as garden variety as well. When you go back and try and sort out what led to the correction, it's not, it could be anything or nothing at all. 20% or greater corrections, known as bear markets, shown all the way to the left, tend to happen a lot less frequently, about 0.3 times a year, almost always associated with either a recession or extreme valuation or runaway inflation that leads the Fed to raise rates or some form of irrational exuberance. And I don't think that we have any of that in place right now. Certainly someday we will, but it doesn't look like we have those preconditions right now. That's one person's opinion. Opinions vary at our firm. I'm going to quickly just simply mention that this is the ISM survey or the PMI survey for China, and although the economy is not growing briskly, it looks like the worst is behind us with respect to manufacturing, which has a pretty big ripple effect. And likewise, the blue line that you see here is the year-over-year return for the S&P 500, and the orange line, IndexIQ orange, is the ISM Purchasing Managers Index, which has advanced for 3 months in a row. And as you can see here, historically, there's a pretty good relationship between the one-year return on the stock market and what's happening in the ISM survey, which is the manufacturing cycle. And that has been moving up the last 3 months in a row, which is encouraging. We're looking at a couple of currency charts now. If I had mentioned to you in October of last year that the Fed would raise rates in December, and they would speak a good game that they want to continue to raise rates further, and if rates were to become increasingly negative in Japan and in Europe, what would you have predicted the U.S. dollar would have done, or the euro, or the yen? And chances are you may not have gotten it right. I think currencies are incredibly difficult to predict, and so I think that is the actual main takeaway. The main takeaway here. There have been lots of studies showing how difficult it is to predict the currency market. So what I'd like to do right now is just to quickly recap. It looks like the U.S. and world economies are going to continue to grow. They're growing slowly, but they're growing. While there have been lots of recessions in the past, I'm sure there will be another one in the future, but it doesn't look like it's going to happen now. And more dispassionate indicators suggest that recession fears that have flared up periodically this year are, at least for now, overdone. We think that interest rates are going to remain low for a pretty long period of time. The Fed does want to raise rates, but it's going to do so very slowly. Inflation is not a clear and present danger. Our currencies and inflection points, we just don't know. And so we think that we're in an environment that will prove to be a single-digit return environment over a couple-year period, both for equities and for the broader fixed income market. So in that little presentation in the world economy, you probably picked up that volatility can come from a lot of different sources. It can come from the equity market, both domestic and international. There's interest rate risk. If you take a look at the Barclays Aggregate Index, which is a very popular benchmark, there's a lot of interest rate sensitivity to it, not as much credit exposure. And we're at a period of time where even though we don't think rates are going to rise necessarily that quickly, we are starting from incredibly low interest rates. So the long-term prospects for that index probably are probably not very good. And also, currencies fluctuate, and they can move independently from their local stock markets. And so that can complicate things when it comes to international investing. And so there are ways to mitigate and manage these different risks, steps that we can take. So what we'd like to do now is ask you, before I turn it back to Sal, what I would like to do is just simply ask you a question, which is your top concern. Is it volatility in the equity market? That would be the first choice. Is it low bond yields, which would be the second choice? Would it be geopolitical provocation or economic uncertainty? That's the third choice. Or would it be regulatory in nature, particularly the upcoming implementation of the fiduciary rule? That would be the fourth choice. If you just be kind enough to take a moment to answer this question, I think we'll all benefit from seeing how those of us together on this call responded. That's interesting, Sal. I think it looks like the concerns are varied, but they're more market-related concerns as opposed to regulatory concerns. Does this surprise you at all?
No, I'm actually not surprised because, depending upon what type of client base you have and how your portfolio is structured, I could see any one of these three main areas: equity, volatility, low bond yields, or the geopolitical uncertainty sort of becoming a key issue for you to try to focus on. So really not that surprised to see these almost equally distributed with a little bit more of a tilt to the economic or geopolitical risk. So thank you, Charlie, for that very detailed economic analysis and outlook. Clearly, definitely not a bearish outlook, a reasonably benign outlook.
I would say cautiously long-term optimistic.
Cautiously long-term optimistic is a great way to put it. However, we do know, and as Charlie mentioned, volatility can spike at any point in time, sometimes for no reason at all. And there are those garden variety corrections in the markets that we need to be prepared for. And so we want to take these sort of in order. We'll talk about equity market volatility and some solutions in the liquid alternative space that might help to mitigate that. We'll talk about fixed income and interest rate volatility and some solutions that potentially could help your portfolio there. And then we'll wrap it up talking about currency volatility, specifically, obviously, investing in the international markets and different ways of managing that type of volatility. So we have here on slide 24 is a sort of a different way of measuring volatility. So most people look at standard deviation as a measure of volatility, which is fine. I decided to calculate intraday volatility. So the intraday volatility, we defined it as the drawdown on any given day from the high point to the close. So you take, for every given day, you take the high point, and this is done on a daily basis going back to 2001. You take the high point of the S&P, of the SPY, the ETF, the S&P 500, the high point for the day, the close of the day, and you calculate the difference, and that would be a potential drawdown. And we average that for every single day, and those are the blue bars. And we kind of cut this analysis through the first 2 weeks of February in 2016. We also overlaid on this what the return is for the year on the right-hand chart, and that would be the red line. And not surprisingly, there's a pretty good relationship between intraday volatility and subsequent returns, and it's actually an inverse relationship. So as that volatility spikes up, as the blue bars go higher, the red seems to drop. And that's certainly what we saw earlier on in this year, where we saw intraday volatility reach levels only exceeded in 2008, and the returns were down about 11-12% through February 11th. So while the economic outlook hasn't changed all that much over the course of the year, certainly oil prices have rebounded some, there have been some shifts, we are always susceptible to these potential quick drawdowns in the equity markets. So there are a couple of liquid alternative solutions in the ETF form that we've developed that really we think can help to try to manage some of this equity market downside volatility. So we have two boxes on this slide. The box on the left shows rolling 3-year risk and return scatter plots for the S&P 500, which are the green triangles, and the orange triangles are the risk return scatter plots. Again, each dot represents a 1-year period going back 3 years for the QAI index, the IQ Hedge Multi-Strategy Index, which is the index that underlies QAI. What we like to point out is the consistency of the volatility profile of QAI, almost regardless of what you saw going on in the equity market. So the standard deviation on the equity market on a rolling 12-month basis has varied anywhere from 7 to 14%. The volatility profile for QAI has stayed pretty consistently between 3 and 5%. So it can act a little bit of that sort of buoy in the water as the waves are chopping around all about. It's maintaining its relative positioning. And you can see it's not at the expense of return. While some of the returns are in the negative 2% range, you can see the range of returns looking up the y-axis go up to and exceed 10% on a rolling 12-month basis. So again, regardless of what's going on in the equity markets, this particular strategy has done a very good job of maintaining its volatility profile and has retained its ability to actually offer positive returns. We have a similar box on the same slide on the right. Again, same time period, the green triangles are the S&P 500, but now the orange triangles, instead of being QAI, they're actually now the IQ Merger Arbitrage Index, which is the index that underlies the M&A ETF. And we see a very similar story as we saw in QAI. Again, very consistent volatility profile of 3 to 5%, regardless of the range of volatility going on in the equity markets, and returns that range from about -1% up to 10, 11%. So again, significant opportunities to participate in some of the upside, but reasonably good ways of dampening some of the volatility depending on what's going on in the equity market.
So it allows you to dampen volatility by adding an asset class, in the case of QAI, to a stock bond portfolio, and to diversify further within an asset class, equities, in the case of M&A.
That's exactly right.
Great.
So looking at it another way, and Charlie talked a little bit about the 60-40 portfolio and how 80+% of the risk in a 60-40 portfolio comes from the equity market piece. So we looked over the period from September 2008 to December 2015, and we looked at the volatility of a portfolio, a 60-40 blend portfolio, and that's represented by, on the left-hand side, by the 60-40 is the blue bar on the left-hand side. And we started working in 10, 15, and 20% allocations to the IQ Hedge Multi-Strategy Index, and you can see the impact it has on the standard deviation of the portfolio. Whereas the 60-40 portfolio had a standard deviation of around 15.2%, that dropped to about 14.4, 14.3% with only a 10% allocation to QAI. It drops even further with an additional 5%, so you actually get volatility below 14%. And volatility is down under 13.5% with a 20% allocation to QAI. Another way of looking at risk is not just the volatility or the standard deviation, but the max drawdown. So again, moving from left to right, the blue bar represents the 60-40 portfolio. The orange is a 10% allocation to QAI, and the green is 15%, and the red is a 20% allocation. And you can see how you can systematically reduce the downside risk by adding increments of QAI to the portfolio. So you can go from a 29% drawdown to a 25.5% drawdown. So that's a 3.5% differential, 350 basis points of performance, which can be meaningful in a portfolio.
For a lot of clients that can become nervous once they hit a few bumps in the road, for a lot of investors, this is the difference between sticking with a financial plan and losing faith.
Yeah. So we look at the same set of slides again for M&A as opposed to QAI, and this one will go back to October of 2007. The index for M&A goes back a little bit longer than the index for QAI, so therefore we have a little bit longer cycle. So some of the numbers are actually shifted, but the story is very much the same. So the standard deviation on the 60-40 is about 10%, going back from October 31st, 2007, which was before the financial crisis hit, again through December 31st, 2015. That gets dropped from 10 to about 9.5% with a 10% allocation to M&A. Further drops to about 9.2, and then further drops down below 9% with a 20% allocation to M&A. Similarly, we see a reduction in the max drawdown. So the 60-40 was down about 32.5%. That drops by over 100 basis points by adding a 10% allocation to M&A. Subsequently, adding another 5% to M&A, so you're at 15%, takes you down to about 30.5 drawdown, and then down about 30%. So about 250 basis points, which again could be the trigger for people abandoning an investment plan or sticking with it. So with downside protection, capital preservation is a very important piece of what these funds are trying to add. Let's talk about interest rate risk. Are there fixed income alternatives? We talked a lot about the Fed hiking rates. We know that the expectations have come down. We know what our expectations are. We've shared those with you. So we're kind of curious, what are your expectations for interest rate risk? How many times do you think interest rates will rise through the end, not just of 2016, but let's expand the horizon, go out 18 months, through the end of 2017? Is it 0 to 2, 2 to 4, or more than 4? If you would, please indicate on the radio button on the left your choice and click the submit button.
Well, this is interesting.
Yeah, this is surprising to me.
I would have expected. I would have expected a more even balance between 0 and 2 and 2 and 4. But either way, it looks as though those on the call are anticipating still a very slow Fed tightening cycle, but perhaps even slower than not just than what the Fed is thinking and talking about, but perhaps even a little bit slower than what the consensus expects.
Yeah, I think that these are interesting results. Again, I would have thought...
Or what the market is discounting.
Yes, I think the market is discounting probably 0 to 2 rates, maybe 1 rate hike for 2016, but potentially another 1 to 2 next year. So I would have thought that would have put us in the 2 to 4 range going out to the end of 2017. So it's an interesting result. Thank you for participating and sharing that with us. So let's talk about, should interest rates rise? And again, we talk about the Fed being on the short end of the curve, but most people, when they think about interest rate risk, are thinking out a little bit further to the other end of the curve, maybe on the 10-year. And the two aren't necessarily related. So were we to see an uptick in economic growth, we could clearly see the 10-year yield go up, even if the low end of the curve stayed relatively low. We may see a little bit more acceleration hiking there, but we could see a steepening in the curve. So we went back and looked. Since 2009, since QAI went live, we looked at all the periods where the yield on the 10-year Treasury went up by 40 basis points or more. And those are all indicated by the 11 areas, the 11 charts, 11 delineations on this chart. And what we've plotted here is the interest rate increase in the gray bar, and that's on the right-hand scale. So you can see at each period, it will have exceeded 40 basis points. And then we have 3 plots, a blue plot, a green plot, and an orange plot. The blue plot is the return on the Barclays U.S. Aggregate Bond Index, which is the most common aggregate bond index available. The green is the return on the IQ Real Return Index, which is the index that underlies our CPI ETF, which is meant to be a low volatility, 2 to 3% real return type offering. And we can see that often the IQ Real Return Index outperforms the Barclays U.S. Aggregate Bond Index during these periods of rising interest rates. There have been a period or two where it actually underperformed. However, when you look at the IQ Hedge Multi-Strategy Index, in each of these periods, you see the orange circle is actually higher than the blue circle. So not only can the IQ Hedge Multi-Strategy Index help dampen some of the equity volatility, as we saw in previous slides, it can help dampen some of the interest rate volatility relative to what many people are using in their portfolio to get their fixed income exposure, which would be the Barclays U.S. Aggregate Bond Index. And in every single one of these 11 periods, the IQ Hedge Multi-Strategy Index has outperformed the Barclays Aggregate Index in a period of rising interest rates.
So you know what I think is interesting about the slide also is that, and also the survey question that we took just before this, is that even though people don't expect the Fed to raise rates very much, I think that we all have to acknowledge just how low interest rates are. And whether it's something that happens soon or something that happens further out, that chances are, starting from where we are right now, that there is the prospect that over long periods of time rates could go up from where we are right now, and you just never know exactly when that's going to happen.
Yeah, that's a great point. The other thing I would point out on this is a period where we saw interest rates almost unilaterally, unidirectionally falling. Mm-hmm. But even within that, there were 11 periods, and we were talking about from 2009 to 2015. We know where rates were in 2007 and where they ended up with very low, declining interest rate environment. But even during that, you had these cyclical upticks of 40 basis points or more, which can happen very quickly. And so QAI could be an interesting portfolio volatility dampener against those periods. Even if we're in a secular decline in interest rates, you could have these cyclical upticks. So let's talk, when we surveyed the audience initially, one of the big concerns was global and geopolitical risk and economic risk. And so that can manifest itself in currency volatility. So let's ask you, what are your views on the U.S. dollar relative to the euro? Are you bullish, bearish, or do you have no view? Please select the radio button that indicates your view and click the submit button.
Okay, so this is interesting. A number of people are bullish on the dollar. Not too many are bearish on the dollar, and a lot of people don't know.
Yeah, right.
Let's follow this up with another question. What is your view on the dollar relative to the yen? Are you A, bullish? Second choice would be bearish, and the third choice would be no view.
So almost about the same answer. People are relatively bullish on the dollar, whether it be versus the euro or the yen, which would fit with your scenario that you laid out going into this year or October of last year, where you think you would be. Kind of interesting, a factoid. Most people are bullish on the dollar relative to the euro, so you think you would want to be hedged on your international equity exposure, fully hedged. We've actually seen record outflows this year, and especially over the last month or so, of money moving out of the 100% currency hedged ETFs that are out there. And in fact, some of the largest have lost a third of their assets because people are actually pulling back. So perhaps when voting with their dollars, the general public may be a little bit less bullish on the dollar than the audience is indicating.
Sure, and it also can mean that while people have views, the depth of those views may not be very, very deep.
Right. So let's talk a little bit about currency volatility and what we think is a smart way to deal with the uncertainty. So we know currency is unpredictable and the volatility is unpredictable. So we look at the period from January 14 through March of 2015, and we see the standard deviation was about 5.76, and this is on the DXY index. That jumped almost doubled over the subsequent year. The volatility definitely spiked. So talking again about investor behavior, we saw the dollar get very strong over this period. You can see the blue line move up from around 80 to just about 100 over this time period, the DXY, so a period of tremendous dollar strength. If you look at the actual flows into the currency hedge, the 100% currency hedge, most of those started in the second quarter of 2015, so most investors are actually late to the game. They needed the protection on their foreign holdings when the dollar was rising, but it was not until the dollar had actually almost crested when the money started to flow into the currency hedged product. And it just points to the difficulty in trying to time that currency move. And you can see another way of looking at the difficulty in timing it. You just look at this chart and you can see, well, I'll explain the chart. So you have three different blocks on the left-hand side. You have the developed ex-North America, the Europe region, and Japan. And within each of these blocks you have the unhedged, the 50% hedged, and the 100% hedged. And then moving left to right, you have different annual returns. And so the yellow shaded areas are the worst performance periods within that region, depending on the currency hedge strategy, and the green are the best performance periods. And I'll just pick on the developed ex-North America in 2010, 11, 12, and 13. You can see it jumping back and forth. So in 2010, the unhedged was the best. 2011, the hedged was better. 2012, you wanted to be unhedged again. And 2013, you wanted to be hedged. That's a very difficult call to make on a year-by-year basis. You can look on as an alternative, the 50% hedged was actually right in the middle. So by putting a half hedge on, you were never the best, never the worst. It's a way of reducing the currency volatility.
One point on this, Sal, I would say, is that the additional volatility that can potentially be derived from currencies with international investing is something that that I would view differently if I were in the accumulation phase of life versus the withdrawal phase of life. So during the accumulation phase of life, you have time for compounded returns to do their thing and for the color grid to go back and forth between green and, would you call that mustard?
Sure.
Okay. But when you're during the withdrawal schedule, you really don't want an adverse effect to take place because it's more difficult to overcome that.
Yeah, that's a great point. The other point I would draw on this slide, looking at volatility, it can actually vary not only year by year in a single region, but even different currencies relative to the dollar in the same year.
Mm-hmm.
So we look at 2009, where in Europe, the better solution was the green to be, the best performance was to be unhedged, where the 100% hedged underperformed, whereas in Japan it was the reverse. You wanted to be 100% hedged against the yen in 2009. So even if you get it right year by year, it can actually vary across the globe within the same year, because all currencies can move differently relative to the dollar.
That's right.
And so how much can this 50% hedge help reduce the volatility? Well, we did a study looking from 1985 to 2015. 1985 to 2015. We actually found that a 50% hedge can actually take away up to 80% of that currency volatility.
It's funny. The reason for that is that the relationship between local stock market returns and the currency is not linear. It's a curvilinear relationship, and the correlations can change over time.
That's exactly right. And so we call this the hedge of least regret. So the 50% hedge sits somewhere between the unhedged and the 100% hedge. If it's right exactly in the middle, but you get a little bit more bang for the buck, so you get more than 50% of the volatility reduction, essentially from a 50% hedge.
So after hearing the material that you've heard today, we're curious if you plan to increase your exposure or not to liquid alternative ETFs in the next year. So we'd just like to know, you shared with us earlier on, and with others, so that we could see as a community how we're thinking, and whether your weights are for liquid alternatives. And now we'd just like to know if your plan is to increase those weights to click on yes, or to decrease those weights to click on no in the next year, or if you need more information in order to make a decision. We'd just be curious as to where people stand, because this is a growing realm of the marketplace. Okay, and so more plan to increase their exposure, and certainly a lot need more information.
Yeah, and we would encourage anybody who needs more information on liquid alternatives in general, any of the strategies that we discussed today, please go to iqetfs.com, reach out to your local salesperson, and we can certainly provide you with more educational information about using liquid alternatives to manage volatility.
And there's also a lot of information on the website.
Yeah.
Well, thank you, Charlie and Sal, and again, thanks to our sponsors, IndexIQ and New York Life Mainstay Investments. We do have time for one question. When it comes to currency hedging, what is the cost involved in that, even on the 50-50? Because there's some school of thought out there that in the long term it's a zero-sum gain. Could you address that, please?
Yeah, so the cost of the hedge is really the interest rate differential between the two countries or currencies where you're trying to hedge against. So, for example, when you're looking at the yen and trying to hedge some of the yen exposure, what you're really doing is putting a forward contract on to be short the yen and then long the U.S. dollar. And it's the financing cost is the only cost involved in doing that, and that financing cost is really just the spread in the short-term rates, which right now are actually very low, and in fact, it's slightly positive to the investor because of the negative rates in Japan. So in this particular environment, you're actually making a little bit of money on the cost. It's actually a positive to the fund from doing it. That doesn't always work that way. We are in a bit of an unusual period, but it typically is fairly low, especially when you have interest rates that are very similar across the different countries.
Great. We could squeeze one more in. We can go over a little bit, and then I believe the broadcast may just be interrupted. But when it comes to QAI, can you explain the underlying and how it works in terms of when the market's correct and how it seems to actually hedge that? What is the mechanism?
Yeah, so because of the overall structure of the strategy and the way it's put together, it typically has a beta of around 0.2 to 0.3 relative to the equity markets. So its downside capture ratio has been about 20% or less. And what we've seen is kind of interesting. At the beginning of this year, when the S&P was down about 10%, QAI was down about 2%, so right in line with that 20% downside capture. We've seen actually in other periods where the equity market starts getting worse and worse and worse, that percentage downside capture actually gets even better. So as the equity markets get worse, maybe down 10%, 15%, 20%, QAI will still capture some of the downside, but actually on a proportional basis captures less. So that 20% downside capture can go to 15 or even 10% downside capture as the equity markets get even worse. So because of its exposure to other asset classes and the natural diversification built in to the strategy, it actually gets a little bit better on a relative basis as the markets get even worse.
Thank you, Sal, and thank you, Charlie, and that concludes our webinar. Just a reminder, there's an on-demand version of the webcast will be available in approximately 24 hours, and it can be accessed using the same audience link that was sent to you earlier. We want to thank you for your attendance, and have a great day.